Welcome to the Opening Bell Report.
Okay, we've got an investment analysis report in front of us today. A very ambitious one.
A very bullish one, yeah.
It's titled 643% Growth Forecast Fire. The Truth About Datavault AI, DVLT. It's a strong buy thesis, all built around this pivot to data monetization.
There's a ton of conviction in here, you can feel it. But I think we can make it much more persuasive for the kind of reader this is aimed at.
I agree. The writer really zeroes in on the upside. The IBM partnership, the data exchange platform, it's an exciting story.
It is. But when you're arguing for a multi-bagger return on a microcap stock, you have to get ahead of the skepticism.
And the current structure feels a little imbalanced.
That's the word. It creates an imbalance that, paradoxically, kind of weakens the whole argument.
Let's start right there with that imbalance. The report dedicates a lot of space and detail to the bull case.
Oh, absolutely.
But then you get to the risks, the bear case section, and it feels like a footnote. It just mentions that the company is burning cash and has a history of losses.
Which brings us right to our first major point. The current presentation of the bear case is concise but could be significantly strengthened to match the robustness of the bull case, and that would increase the overall credibility of the whole analysis.
Why do you think the writer went so light on it? Just hoping the big 643% number makes people forget about the risks?
I think it's probably just a reluctance to dwell on the negatives, but the effect is the same. I mean, for a high-risk, high-reward stock like this, the main risk is cash burn leading to dilution.
The existential threat.
Right, and it's stated, but it's not really analyzed. There's no scope, no timeline. The sophisticated investor knows that dilution is the clock ticking down on execution.
So if you spend paragraphs on the tech, but only a sentence on the potential for capital destruction, you lose trust.
You lose trust, exactly. The risk section needs to graduate from a footnote to a real tactical breakdown.
So how do you do that? How do you make that risk analysis feel just as robust as the upside without, killing the bullish tone?
The suggestion is to directly tie that dilution risk to specific, measurable financial parameters.
And to the execution timeline.
So you're showing that the risk is quantified, not just glossed over.
Precisely. It shows you've done the work.
Okay, so let's give some concrete examples of how to frame that. Absolutely. First, you have to transform that abstract cash burn rate, the negative EPS, into a concrete runway calculation.
A countdown clock.
Yes. The writer should go find the company's stated cash reserves, their working capital, and use that to give the reader a real estimate. How many quarters can they survive before they need more capital?
That's a huge shift. It shows you've really stress-tested the idea.
It does. And second, you can isolate the specific triggers that would force that dilution.
What do you mean?
You state the dependency outright. Something like, if the projected revenue from the IBM integration is delayed by more than, say, 6 months, a cash raise is unavoidable.
So you're defining the failure point. That makes the whole thing sharper.
It does. And one last thing on this point. The report mentions the company used to be Wisa Technologies?
Right, the hardware company.
That's a perfect tool. Briefly contrast the cash needs of the old hardware model versus the new data monetization pivot. Show how the strategy shift changes the burn rate. It adds historical context and real depth to the financial analysis.
Okay, that makes sense. Moving on to execution then. I see this section on recent catalysts.
Yeah, this part is interesting.
It highlights two things, the FinTech TV integration for their bias meter and this technical observation about a 108 million share volume spike.
Both are strong, verifiable data points. The market is definitely reacting to something.
But they feel a little disconnected from the main story.
That's it. And that leads to our second point. To maximize the report's persuasive impact, the specific recent catalysts need to be more explicitly woven into the central monetization thesis to clarify how they actually validate that 643% growth path.
Right now, it reads more like a list of good news. Why is that not enough for this kind of analysis?
Because when you forecast 643% growth, you're asking for a massive leap of faith from the reader. You need to show them the engine is already running, even if it's just idling.
So the weakness is that the reader has to connect the dots themselves. How does the FinTech TV launch prove the whole tokenizing data model actually works?
You have to close that gap. The catalyst can't just be news, it has to be proof.
So the suggestion is to reframe that whole section. Show how these events are de-risking the future that the big forecast depends on.
Precisely. Let's start with the FinTech TV deal. It's a perfect example.
Because it's a real-world application.
Exactly. The writer needs to state explicitly that this is a public, functioning example of their IDE platform in action. It's verifying data, it's monetizing it on a visible scale. even if that scale is small right now.
That makes the tech suddenly feel real and graspable. It's a live demo.
It is. It's verification that the tech is ready for the market. It's not just a partnership announcement, it's proof of concept.
Okay. Now what about that volume spike? The report uses some technical jargon, consolidation before expansion. That can be a turnoff for a fundamentally focused investor.
It really can. You have to translate that technical analysis into fundamental conviction.
How?
You tie the trading volume directly back to the most critical, fundamental driver. You could say something like, the high volume suggests institutional investors are beginning to price in the execution of the IBM Watson X integration.
Ah, that's much more persuasive. It's not just a pattern on a chart, it's smart money moving because of the fundamentals. The market is confirming the thesis.
It has to feel earned. And a final thought here. The report could try to quantify the fintech TV exposure. Even if the fees are minimal, show how that translates into revenue. Show the monetization mechanism is working. And that's the first step towards that massive revenue goal.
That feels like the perfect bridge to our final point.
It is.
The entire bullish argument is anchored on that one staggering number, 643.9% revenue growth. The whole thesis is that the stock is fundamentally mispriced because of this projection.
Yes, and that brings us to the core issue. The entire bullish premise is built upon that staggering 643.9% revenue growth rate and the $4 price target. Therefore, the analysis must bolster the credibility and the source of the analysts behind these crucial numbers.
So where's the logic breakdown here? What's the weakness?
It breaks down at the point of attribution. For a microcap company that's pivoting its entire business model, the phrase analysts are projecting is just, it's not enough.
It's too vague.
It's way too vague. A sophisticated reader immediately asks, which analysts? Are we talking about big banks or some small independent firm? And what are the heroic assumptions they're making to get to that number?
Right, that lack of transparency makes the number feel abstract, not like a fact.
It weakens the entire logical support for the thesis.
But how do you provide that detail without getting bogged down? Don't you lose the punchiness of that headline number if you spend 2 paragraphs explaining a discounted cash flow model?
You don't sacrifice transparency for punchiness. You make the transparency part of the punch. The suggestion is to bolster the evidence by actually investigating and presenting the core assumptions behind that 643% number.
Show the math.
Show the math required to get there.
Okay, let's give some specific ways to do that. How can the writer make that $4 target feel earned?
First, be transparent about the valuation methodology. Is that $4 target based on a DCF model that assumes a successful launch? Or is it based on applying peer multiples from the data sector to that forecasted revenue?
Just revealing the path the analysts took?
Yes. It makes the target feel grounded in reality, not just optimism. It lets the reader evaluate the logic for themselves.
That makes a lot of sense.
And second, you have to break that abstract 643% figure down into required key performance indicators, KPIs.
Make it tangible.
Make it tangible. The number is just a number until you translate it into execution. For example, how many new enterprise clients does DVLT need to sign up in the next year? What's the average fee they need to charge to hit that revenue target?
That makes the forecast less of a wild guess and more of an executable plan. The reader knows exactly what to watch for on the next earnings call.
And one last thing on this. Address the source head on. If the projection comes from a narrow source, which is common for microcaps, acknowledge that.
And explain why that source should still be trusted.
Exactly. You could say, this forecast comes from firm X, which specializes in AI pivots, and accurately predicted the growth of a similar platform last year. That turns a potential weakness into a point of strength.
Okay, that's a really clear path forward.
Don't forget to like, share, and subscribe for more.